most VCs do not lead deals. Hey guys, what's going on? John Henry here. Thanks so much for popping into my YouTube channel. Like, subscribe if you haven't already. Today, we're going to get into how to raise your first $1 million for your startup. Many of you guys know my background. Been an entrepreneur for about 9 years. I've bootstrapped businesses from the ground up with no outside capital. I've also been an angel investor where I've put my own cash to work in about 8 companies over the years. And most recently co-founded a venture capital firm called Harlem Capital, where we raised $40.3 million to invest in women and minority-led companies. By the time I left this year, 2020, we were seeing about 1,000 deals a year and investing in just 1% of those 1,000 deals. So only 10 companies received capital from us as a venture firm. So yeah, I've been fortunate to have a look at the process of raising VC from a few different sides of the table. And most recently, since stepping down, have co-founded a new venture that I'm now working on and raising capital for right now. So I thought to make this video because it's been interesting to experience this whole journey first from a founder's perspective, make my way to running an incubator, running an accelerator, being a VC, and making my way all the way back around the circle back to being a founder, just kind of absorbing and really processing some of the lessons as I'm kind of in the trenches right now. It gets a little bit easier in that I know now how to package the round. Raising VC is a hard thing to do. So if you're watching, you might be a first-time founder, you might be a multi-time founder. It's still a hard thing to do. So I thought I'd make this video to share my thoughts and perspective on what makes for raising a round of venture capital successful so you can go out there and raise your first $1 million. First things first, you have to know if venture capital is for you. You're dealing with investors that don't invest their own money. VCs raise money from other people, other funds. Therefore, they have expectations to deliver returns to their investors. And it's really important to know venture capital is an incredibly risky asset class. Most of the capital that's put to work in venture goes to a zero. And so therefore, you need a equal and reciprocate reward for that very high risk that you're taking. VCs and even angels invest their own money. VCs are professional fund managers. Both angels and VCs are investing in startups that have the potential to grow really large, really quickly as a way to offset that risk of the fact that the majority of their investments will go to zero. It's a weird game, I know, but if you are starting a franchise type of business or any other kind of small business, which are great businesses and cash flow, frankly, a lot of startups don't, this is likely not the avenue for you. So first you have to know if VC is for you. And with that disclaimer and kind of those bookkeeping items out of the way, let's get into what I think can improve your odds to raising a round. Number one is understanding your round. How much are you raising? How much are you looking to give up? I can give you some benchmarks. On average, a typical seed stage company is giving up about 20 to 25% of the company in the first round. And your valuation sounds silly. You kind of just make it up and you go based on averages. Right now, the average valuation of a seed stage business looking to raise capital is anywhere from $4 million on the low end, all the way up to $10 million, I would say, on the high end. Now that's the range. And again, this is based on many deals that I'm seeing right now and saw most recently as a VC. Now it's important to note when you watch this video really matters. The venture markets, just like any other market, is constantly ebbing and flowing, going up and down. But I can say over the last 2-3 years, the norm has been that $4 to $10 million benchmark. The way you price your business, you try to price it based on how much traction you have and how reasonably can you defend your valuation. For instance, if you try and raise at a $10 million valuation, which we've established is the higher end of what seed companies are raising for, you better also be on the higher end of traction. You better be post-product, you better be post-revenue, you better be multi-founding team, or you have some kind of contract, or whatever the case may be. Typically, when you see a company raising on the higher end of the norms, investors, then they usually have a higher amount of traction to show for it. And then conversely, if you are pre-product, pre-revenue, and you're kind of a newer team, you might consider pricing your startup on the lower end of that range so that you adjust your pricing such that you can make it a reasonable bet for a venture investor whom ultimately is looking to buy as much as they can in your business. So that's number one, is understanding your round. How much are you giving up at what valuation? Again, typically you're going to give up 10 to 25%. The range is going to be anywhere from 4 to 10 depending on how much traction you have. Now, let's get into the fun stuff. Number two is having a really strong pitch deck. The deck is one of the keys, if not the key, to raising VC, period. Most people will interact with your deck before they interact with you. This is your sales tool. If you have a really strong ability to sell the company in words, the challenge is making sure that that story is encapsulated in a way that behooves you or that flatters the business in a way that is as effective as your ability to tell the story in the deck. It is a hard thing to do. I've gotten good at making decks over the years, but it's been a frustrating journey, and it can still be frustrating. I am very, very tediously careful with my decks. You have to strike a balance of being informative but not boring, enticing but not misleading, share the vision but not look unfocused. And it's gonna take practice, but I can give you a few tips on the pitch deck. One is a lot of you guys will go out there and download pitch deck templates, which I think work, but try this instead. Try making the deck fit into how you tell the story, not vice versa. If you take a template and try to fit your story to the template, when you pitch the deck, it's going to come out really botched up in my experience. What has worked better for me is to get away from a computer, I get away from any screen, and I tell the story out loud naturally how you would tell someone who's on the other end listening. I would first start with the vision of what we're looking to do to get people excited, give them a little bit of background about myself, and then I kind of establish why we exist. Look, the system is broken, and here's why. And here's what that status quo is leading to. There's a big group of customers that are overpriced and underserviced as a result of this problem. And so here is our solution. Here's exactly what we do. Let's dig a level deeper into it. Here's how we do it in a way that's different. And then I might go into, look, there's other people in the space, but here's how we are different than them. And then ultimately, here's exactly how it is that we intend to go to market, find customers. We're exact right team to do it because of these reasons. And this market opportunity is huge. It's enormous, and we think we can slot into it really nicely. Then I'll wrap it up with, here's where we are as a business. Here's our timing. Here's when we anticipate being live in the market. And so that is how I pitch naturally as a person with no materials. I created my pitch deck to fit into the format of how I pitch in person. Another tip that could be helpful is knowing which VCs lead and which VCs follow. Now, here's a reality. Most VCs do not lead deals. Most VCs like to play it like they're big shots, but in reality, they're timid. They follow. There are actually only a small number of firms that are known to lead rounds. That is, you have to have gut and conviction, because it does take guts to find a deal that maybe no one else is invested in, but they feel like, there's something here, and they take a big position first. What you can do is A, just Google firms that lead in the early stage, but also B, Google firms that like to invest in your industry. Find more and more reasons why you are a fastball down the middle for a particular firm. If you can find a diverse firm that has a particular over index on your industry, the more closer to the bullseye you get for a firm, the more likely you are that you'll at least get very serious consideration. So knowing who leads and who follows is absolutely key, because followers follow, and they're gonna follow the signal of a lead. Now, the tricky thing is you typically will want some traction to get a lead comfortable and validate their gut. That leads me to my next point. Angels. People really grossly underestimate and underutilize angel investors. Angel investors write their own cash as part of their investment, and so they don't typically invest a whole lot. They invest 25K, maybe 50K. Their purpose is not to be the rainmaker, but angels are often connected to A, other angels, but B, other networks of people that invest. And a lot of the deals that we invested in at Harlem Capital came to us referred by an angel that we had great respect for. And so angels are very crucial part of the investment ecosystem. They're known to come earlier and they're known to be plugged. If you can get an angel to support you early, then what you're doing is you're extending the power of your network through them and allowing yourself to get to other little groups of investors that you maybe didn't even know existed. You're just increasing the number of potential conversations that you can have, which is definitely what you want to be doing when you're raising a round. Another great tip here is you must have a VC tracker. This is a document that quite simply keeps track of whom you'd like to pitch, whom you've already pitched, and where they've shaken out as far as a response goes. This may sound simple, and it is simple, but it's really effective. I found when I first started pitching, I would try and keep track of everyone in my head or in my email, but you'll see it quickly gets out of control. For me, having a document that lists out the firms that I'd like to get in front of, specific partners within that firm, what industries they're known to invest in, how big of a check size they typically write, if they lead, yes or no, someone who can introduce me to them, and my last point of contact with them. That is really all you need. I use Google Sheets for it. I keep it super simple, but I refer to my VC tracker several times a day. It helps you as a founder get a real good sense of whom you need to reach out to, whom you're in a first meeting with, whom you're in a second meeting with, whom you're in diligence with, whom passed and why, and whom has committed. And you'll find that getting very good clarity around where you are at every step of the way, it helps you focus your energy on the people that are most likely to be potential yeses versus wasting any energy on where were they again, or I forgot what stage they were in. Or the more lean you can be in your mental energy, the greater the potential outcome. Dealing with the no's with tremendous grace. By the law of numbers in this game, you're gonna deal with more people that say no than that say yes. If every no is a dead end, then that to me is a wasted opportunity. I would rather take a no and turn it into potential introductions that could then lead to more conversations. It's really what you want to be optimizing for, is more and more relevant conversations with decision makers. So every time someone takes a pass on my investment, even if I'm disappointed, I'll say thank you so much. I appreciate your consideration and your time. I appreciate that you took a look, and I respect your decision. Now, is there anyone in your network that you feel would be interested to take a look? In some cases, I would even have a very good idea of whom in their network I'd like to get in front of. And sometimes you can do that by simply popping them in on LinkedIn and seeing what mutual connections you have second or third degree away or first. And you can turn those no's into, hey, I noticed you were connected with such and such. You think this would be a good fit for them. I would appreciate the introduction. Just by having that simple line that you use at the end of a investment process that leads to a no, you can turn every no into a potential 1 or 2, maybe 3 introductions. If you pitch 100 people that all say no, if out of those 100 people, 50 of them introduce you to another 2 people, then you have another 100 conversations. What you've done is you've refilled your funnel with new leads, and you're having relevant conversations with decision makers. Increase the frequency with which you're having these conversations. So I find that dealing with those no's with tremendous grace leaves the door open with that particular individual for subsequent rounds, but it also can open doors for people that can invest in this round. Those are some of the tips I have. Raising a round is an incredibly difficult thing. I am a multi-time founder with a lot of experience raising capital as a VC, as a real estate operator, investing capital. You'll never find someone that says, hey, raising is easy. It's always trickier than it seems. It always takes a little bit longer than you'd like. So if you're out there raising capital right now, know that you're not alone, but hopefully some of these tips can help you get organized in your approach, from keeping a real clear document of tracking folks to having a really compelling set of documents that get you to a second meeting, to how to turn those no's into additional introductions, and to get angel investors on your side early that can increase the quality of warm introductions that you're getting out there to the extended network. I hope this was useful for you guys. Please like and subscribe. Leave your comments with any thoughts or additional tips that you may have. If you like this video, go ahead and share. It would mean a lot to me. Thanks again for tuning in, and I look forward to doing more of these.